Welcome to this lecture on the triangulation provisions, Article 42 of the VAT Directive. So let's look at the situation that we are going to consider in this lecture. Now here we have a German registered company selling goods to a UK company, which will then in turn sell them to a French company. All three parties are VAT registered in their respective member states. Now, rather than transport the goods from Germany to the UK and then on to France, it would seem sensible for the goods to go direct from German co to French co. So that's what's going to happen. They're going to go direct from German company to French company. Now, if we look at the provisions, the basic provisions, the goods are leaving Germany. Now, under Article 32, that is a German supply. Because the UK company gives the German company their UK VAT number, in Germany that supply will be exempt with credit. Now the UK company, because they've used a UK VAT number to secure exempt with credit treatment from Germany, Article 41 will apply. Unless, of course, they can prove that they've accounted for Article 40 VAT at acquisition in France. Now, to account for acquisition VAT in France, UK Co would have to register for VAT in France. Now, that's the problem, because what we've got here is the UK company has this registration obligation because of the Article 40 VAT due in France. They're acquiring the goods from German Co. Acquisition VAT is due in the country where the goods end up, France, so Article 40 VAT has to be accounted for. So let's say that UK company did register for VAT in France. They would then recover their French acquisition VAT via their French VAT return. They would then charge French output tax on their sale to their French customer. The French customer would then recover the French VAT that they have been charged by UK Co. And that just all seems a bit pointless, and because it creates an unnecessary registration. If the French company is going to recover the VAT, or be in a position to recover it, then why does the UK company have to register to get to that point, i.e. charging VAT to the French company for which they would then recover? Now this is what triangulation, the simplification, is all about. So under Article 42, we have the same three companies, German Co, UK Co, French Co. We have the UK company issuing a VAT number to the German company. That triggers the Article 41 liability. Now normally that is avoided if they can prove that they have accounted for Article 40 VAT in the country of destination, i.e. France. Now what Article 42 does, it disapplies Article 41 as long as the French company accounts for acquisition VAT via the Triangulation Simplification procedure. So essentially, as long as someone pays the Article 40 VAT, then Article 41 won't apply, and the UK company won't have to apply acquisition VAT because they've issued a UK VAT number. And what this does do, therefore, is avoid the UK company having to register for VAT in France. The French company can account for the acquisition VAT, and the French company can then look to recover it. So let's have a look at this simplification process. Now here we have those same three companies, so German Co, UK Co, French Co. Invoices raised from German Co to UK Co to French Co, and then goods go direct from Germany to France. Now because the goods go into France, there is an Article 40 acquisition VAT liability, which the UK company will have to account. Now, by accounting for the Article 40 VAT, then they avoid the Article 41. But obviously, to account for it, they would have to register in France. So if the UK company adopts simplification, the Article 40 liability shifts from the UK company to the French company. So the French company will account for the acquisition VAT. Now because of that, there is no Article 41 obligation in the UK company, and because Article 42 says that as long as somebody pays the Article 40, acquisition VAT, then Article 41 is not in point. So that's the simplification. It avoids the UK company having to register in France, and effectively the French company would account for the acquisition VAT that's due under Article 40. There is no Article 41 in the UK company, even though they've used a UK VAT number to secure the exempt with credit transaction from Germany. So it is a simplification, because essentially there's no VAT loss here, and because the French company has to account for the acquisition VAT, and obviously if they're partially exempt, then they would suffer the VAT just as they would if they bought it direct. So there's no VAT loss, and it's quite a simplification. It stops these unnecessary VAT registrations. Now, the actual simplification itself is found within Article 197, and this states that VAT shall be payable by the person whom the goods are supplied, i.e. Frenchco in my example, when the following conditions are met. The taxable transaction is a supply of goods carried out in accordance with the conditions laid down in Article 141, so we'll look at that in just a moment. So there's some conditions that we need to comply with. And the person to whom the goods are supplied, the Frenchco, is another taxable person, or non-taxable legal person, identified for VAT purposes in the member state in which the supply is carried out. So I'm selling to Frenchco, the Frenchco is registered in the member state in which the goods arrive. So that's that condition within Article 197 met. And C, the invoice is issued by the taxable person not established in the member state of the person whom the goods are supplied, and that must be drawn up in accordance with Articles 220 to 236. So essentially the invoice raised by the UK company to the French company must be in accordance with Articles 220 to 236. So they're essentially the conditions. And that's what we've got. We have got that actual situation. So we meet the 197 triangulation provisions. We are effectively passing the obligation over to the French company, and they can account for acquisition VAT. Now, there are 4 conditions within Article 141. Now, if you meet these conditions, then the obligation to pay the acquisition VAT passes under 197 to the Frenchco. Now, under Article 141, the acquisition of goods must be made by a taxable person who is not established in the member state concerned, but is identified for VAT purposes in another member state. So we'll look at that and how we've got that in just a moment. B, the acquisition of goods is made for the purposes of the subsequent supply of those goods in that member state by the taxable person, i.e. the middleco. C, the goods acquired by the taxable person referred to in point A are directly dispatched or transported from a member state other than that in which is identified for VAT purposes to the person for whom he is to carry out the subsequent supply. So we'll look at that in just a moment as well. And D, the person who the subsequent supply is made is another taxable person or non-taxable legal person who is identified for VAT purposes in that member state. And the person referred to in point D has been designated in accordance with Article 197 as liable for the acquisition VAT. Now, if we look at our example and how we apply these conditions of Article 141, so we've got the 3 companies. This time I'm going to change it. So I've got Italian company registered, Spanish company registered, German company registered. So new example. And the invoices are going from Italy Co to Spanish Co, and then Spanish Co is billing German Co. Now the goods are going to go direct from Italy to Germany. Now if we look at the conditions, now if we look at 141A first, we've got a registered company in Spain, whereas the acquisition of the goods is in Germany. So 141A. 141B. The Spanish Co is intended to onward supply those goods in Germany, i.e. the country of acquisition. So condition B is met. 141C, the goods are going direct from Italy to Germany. That condition is met, i.e. going from another member state, i.e. not Spain, into Germany, so the customer's member state. 141D, our customer must be VAT registered. that condition's met. And finally, under 141E, acquisition VAT is payable by the German company. So in this particular situation, all the conditions within Article 141 are met and simplification can apply. The German registered company will have to account for acquisition VAT, that's Article 40 acquisition VAT, in Germany. The Spanish company has avoided registering in Germany to account for that acquisition VAT by adopting simplification. The German company will take on that responsibility. Right, just one more point to mention on this screen. The invoice raised from the Spanish company to the German company must obviously comply with the normal provisions within Articles 220 to 236, but one of the extra provisions is that there must be some narrative on that invoice to inform the German company that they've got to account for acquisition VAT. So something like Article 141 simplification applies. The German company obviously has to realise that they must account for acquisition VAT on this purchase. Just one or two more points to mention on the simplification, triangulation. Now, triangulation, the simplification, is specifically directed at triangles. You've got to be looking at 3 EU registered parties and 3 separate EU countries. If there are more than 3 parties or countries, then it will not be applied. If, for example, we had 4 parties and the Italian company was selling to the French company selling to the Belgian company selling to the German company, and the Italian company were directed to move the goods via Switzerland to Germany, then we don't have a triangle. And what we've got here is acquisition VAT, Article 40, due in Germany. Now that will mean that one of the parties will have a German registration obligation. Whether it's the Italian, French or Belgian company remains to be seen. That would depend on the individual situations. But one of these parties will be registering in a different member state than the one they are already registered in. If you want the simplification to apply, then you have to form a triangle. So maybe the goods could go from Italy to France, and then from France to Germany. Then you have your triangle. To finish this session, we're going to look at a case, VSTR. And this flies in the face of what we've just said. But it's an important case, so we need to just understand the issues from it. It is an exception to the normal rule. Now, in this particular case, a German company was selling goods to a US company that was in turn selling to a Finnish company. And the goods, as you'd expect, went direct from Germany to Finland. Now, the place of supply is Germany, so is German VAT due? Well, normally you'd be expecting a VAT number to come, and that would mean that you could exempt it with credit. But US Co didn't provide a VAT number. So the German authorities wanted output tax from German Co. Now, the European Court held that a VAT number need not be the only way of proving taxable person status. So in this particular case, it was correct to have it exempt with credit from Germany, even though the US company did not have an EU VAT number. There was sufficient evidence to prove that they were a taxable person. Now, obviously, this case just focuses on the German company. It doesn't look at the Finnish provisions. Now, based on what we've just looked at, or gone through, then you'd be looking at this and say, well, acquisition VAT is due in Finland, is it not? Article 40. Should US Co be accounting for acquisition VAT in Finland and then selling the goods on to Finnish Co? Well, that would be the way that I would read this case. So therefore, German Co has other evidence to prove taxable person status. Like a lot of these cases, they only consider individual transactions. So the German company's sale was the only thing the European Court were considering in VSTR. Beyond that, it wasn't the point that was referred to them. That concludes the lecture on triangulation.